We have some noise surrounding the stock market this month, with the US Fed penciling in around one interest rate cut for the end of 2024. We do also have another article from Reuters who are specific, saying that we will see 2 rate cuts, with the first one being initiated in September. And why this is important is because when we do look at the S&P map year to date, we see the majority of companies have performed very well. The likes of Nvidia, Microsoft up very strongly. But when we do hone in on essentially the REIT market, what we can see as a whole, REITs have performed fairly poor. In fact, a lot of them are down double digit. And what this means is that there is expectation that with the rate cuts, we will hopefully see a lot of these companies rebound. Now, it isn't just a theory, there is some data behind this. And on top of that, what is interesting to note is that more recently we have Bank of America fund managers who have been increasing their REIT positions within their portfolios. We can see a plus 15% change in the allocations, and the main reason for this is there is a lot of expectations that REITs will be among the best performers when the Feds do cut in 2024, which, as we have just seen, the expectation is between 1 to 2 cuts. Now, what this means is that today we're going to look at 5 undervalued, very high quality REITs that we do believe you should be considering for your portfolio. As always, we will look at each one of these historical performance. We'll touch upon their dividend safety, as that is also a very important consideration, and we'll also go through the underlying financial metrics, talking about the metrics to look for, how strongly they are. And for each one of these 5, what we're going to do is include our valuation model, getting to the intrinsic value of each one, what is our acceptable buy price, factoring our investor margin of safety, and seeing exactly what percentage increase do Wall Street see for each one of these over the next 12-month period. First one that we want to draw your attention to, it is Rexford Industrial Realty. Now, we do have a double buy from Seeking Alpha and Wall Street, although we do note one hold from Quant. Each one of these 5 that we will go through has a minimum of 2 out of 3 buys. With this particular REIT, we do see it trading towards its 52-week lows, and it does have a fairly nice starting yield of around 3.51%. with a P to FFO of around 18.84. Later on, we will compare it to the sector, so you do understand whether or not that does look undervalued from that aspect. And over the last year, it is down around 13%. If you've been a long-term shareholder, well, you would be up 220% over the last 10 years, and you would have outperformed the S&P during this essential period. And we can see all-time highs just over $80 around 2 years ago, which is right now trading around half that price. In terms of dividend safety, always great to see an 81 very safe score. Market cap just under 10 billion. It is a mid-cap company. Now, in terms of dividend safety, reaffirmed last month, very safe. What this means, dividend cut based on the analyst does look to be highly unlikely. In terms of the last recession, well, this company wasn't listed, so we don't have any of that comparative data. What we do know, though, we love to see this very strong dividend growth from a REIT as well, around 9.9% this year, double digit over the last 5, double digit over the last 10 years as well. In terms of number of years, well, they have been increasing those dividends for the last 10 years consecutively. Now, throughout today's episode, we will incorporate dividend yield theory, and it does state a company is undervalued when the current yield sits above the 5-year average. So we have our first signal of undervaluation, in fact, a double undervaluation signal, as the forward P to AFFO 22.7 does sit below the 5-year rolling. Do bear in mind, though, please, that we don't look at any of these models in pure isolation. We will conclude towards the end. And the third factor that we can see, it is in fact trading much higher than the real estate sector at 13.7. In terms of the payout ratio, now normally on this channel, we always draw your attention to the free cash flow. For REITs, as always, a lot more volatile. So we look at the adjusted FFO, referring to the funds from operation. Below 90% is what we want to see. Below 90% is what we get over the longer term. 88 in 2023, nice to note over the next 12 months, it is anticipated to come down to 85%. We then move on to the adjusted funds from operation per share. Very similar to the free cash flow when we look at other companies. We want consistent growth over the longer term. Again, that is what we see from this high quality REIT, and it is anticipated to continue that upward trend over the next 12 months. We then move on to the sales growth on the right, with other companies 3 to 7, with REITs 5 to 10% growth. Double-digit growth every single year, and what is very impressive with this REIT, it isn't just the sales growth, but also the AFFO per share growth. We're seeing nearly double-digit across the last 10 years, 7% in 23, high single digit anticipated over the next 12 months. So these are very high quality REITs that we do believe you should take into further consideration for your portfolio if you do want to add to this industry. But as always, do your own due diligence. In terms of total sales, well, very strong growth over the last 10 years, more than 10 times in fact. But what we do always have to point out for REITs in general, that you will come and spot the theme in today's episode. They will dilute your position over the longer term, some much faster than others. Main reason, as always, they do retain a little of that internally generated cash flow after paying out the bulk in dividends. We then move on to the ROIC, very important metric, 3 to 5%, 10% or more for other companies that aren't REITs. Major reason for this, it does give us faith management are able to effectively allocate their capital. Very low up until 22. Nice to note 3% in 2023. Hopefully they can continue to increase that over the longer term. In terms of operating margin, well, always great to see operational efficiency over the longer term, increasing from 11 to 37% in the more recent period. And when we look at the net debt to EBITDA, why this is important? Well, firstly, EBITDA referring to the earnings before interest, tax, depreciation, amortization, because below it shows us the number of years it would take the company to pay off all of their debt net of cash on hand. Remember, this does correlate to both balance sheet strength as well as dividend safety. 4.06 in 23, so well below that 5.5 that we want to see. It is anticipated to increase marginally to 4.34, but it's still below, so we can see why that dividend safety score looks to be very safe, and this does show us their balance sheet does also look to be fairly strong. So let's jump into the valuation model. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button, and typically on the channel we do deep dives into every single one of these models. Today we're going to jump straight into our intrinsic value calculation. So in today's episode, the essential intrinsic value is just the average of these two models, coming at just under $60. So what do we do? Well, we have the current trading price around $44. We always use a 10% margin of safety to start off with, and we execute if it meets our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. Well, if you believe that, then it is a buy up to $54, but we keep going till it's near the current trading price. What we can see in today's episode, it is pretty much trading at a 25% MOS level, which does look very strong for what I would indicate personally as a very high quality REIT. Do Wall Street agree? Well, as we can see, they have a price target of $57, a few dollars shy from our intrinsic value, and they believe there to be 28% upside. So again, a definite consideration for your portfolio. But as always, give us your thoughts in the comments below. Now, before we move on to the next REIT, just to let you know, we have released our latest free week where we go through 10 undervalued stocks which have some phenomenal balance sheets. If you want access to this completely free by clicking on that pinned comment, and you also get instant access to all of these other articles and more that you can read straight away. So the next REIT we have is Equinix, ticker symbol EQIX. Now, there was a Hindenburg report that was very short on this company, but after doing an internal audit themselves, there were no issues that were raised, but you can go ahead and check that out before looking at this company. We have a double buy rating, Seeking Alpha and Wall Street, with a hold from Quant, very similar to REXR that we just ran through. It is also trading towards its 52-week low with a forward yield of 2.3% and a P to FFO of 30.44. It is also down 2% over the last 12 months. Again, outperformed the S&P, up 290% over the last 10 years. And all-time highs not too long ago, in fact in 2024, at around $915. Another very safe dividend score, market cap $71 billion, a large cap company. And we can see reaffirmed dividend cut looking highly unlikely. Now, in terms of the last recession, well, they didn't pay a dividend, so no comparative data, but they had well above average growth, plus 25% when the S&P was sitting at negative 12, but they had pretty much an S&P return negative 56 with the S&P itself negative 55. Love to see this dividend growth, double digit last year, double digit over the last 5 years as well, and we can see they have been increasing those dividends for the last 8 years. Now, we then move on to dividend yield theory, and we get another double undervaluation signal on both the yield as well as the forward P to FFO, though we can clearly see, again, very similar to the previous one, the real estate sector does sit lower. As always, though, it can be for many reasons. It can be justified where companies in general do trade at a premium, whether it's their growth metrics, their profitability, or just other things about them which do look to be reasonable. Adjusted FFO, well, pretty low, below 50% in fact every single year. No surprises why they can pay that double-digit dividend. 48% over the next 12 months, also looking very secure. And when we do look at that, this is what I love to see, an absolutely gorgeous picture here. It has been increasing consistently over the longer term, and that is anticipated to increase over the next 12 months. In terms of sales growth, well, very strong over the longer term, and in terms of adjusted fund per share growth, again, pretty consistent, especially over the last 4 years, and anticipated to be high single digit over the next 12 months as well. One of the things that I do quite like to see in companies is that long-term consistency. Total sales, great as we can see here, around 3 times growth over the last 10 years. But while we do note it has diluted your position, not as very quick as we have just seen from the previous REIT. But again, as we said, do take a look at REITs in general just to get a common understanding. In terms of the ROIC, well, it was very high, 2014, 2015, has started to come down, which is a little bit of a disappointment. Nice to note 3% in the more recent year. Again, that is really the minimum we do want to see. Margins have also come down, just something to keep an eye on, 13% in 2023, and we can always factor a lot of these things when we do come to the margin of safety for each individual real estate investment trust company. Below 5.5 on the net debt to EBITDA, again, that is what we see across the board. 3.49 over the next 12 months anticipated, which is pretty low for a REIT. So this is a very good sign that their balance sheet does look very strong. And when we do get into the intrinsic value, and as a reminder, you can grab a copy of this model by clicking on the pinned comment below, running through your numbers, whether it's for this REIT or any other company in your portfolio or watch list. Margin of safety then, 10% based on an intrinsic value of $906, does indicate a buy at 816. At 15%, it buy up to 770, and we can see in today's episode, not at a 20% MOS level just yet, but between a 15 to 20%, again for what I would consider another high quality REIT. In terms of Wall Street, well, they believe the share price will be slightly higher than our intrinsic value, 23% upside, again, another serious consideration for your portfolio today. We then move on to Prologis with a double buy rating again and a hold from Quant, again trading towards the lower end of the 52-week range. A forward yield of 3.5%, P to FFO around 20.2 on the lower end of those so far today. Down 8% over the last 12 months. Over the last 10 years, though, it is up 166%. We do also see all-time highs around 2 years, around the $170 mark. We have a 61 safe score on that dividend. 102 billion, a mega cap company, and when we do take a look, reaffirmed a safe score, which indicates dividend cut unlikely. In terms of key metrics, well, disappointing, they did cut the dividend during the Great Recession. They had significant below average growth, and they massively trailed the S&P, negative 84%. Now, they have increased their dividend double digit just this year, double digit on average over the last 5 years. But if you do look over the last 20, it has been zero, as we can clearly see on this graph. So in actual fact, 10 years of consecutive dividend increases, 12 years of paying a dividend without a reduction. In terms of dividend yield theory, then a double undervaluation signal, always great to start off with your analysis when you see that. But again, unsurprisingly, what we are starting to find out for the higher quality REITs, and that's no surprise at all, they are trading higher than the sector PE. We then move on to the adjusted funds from operation. Below 75%, so we do become a bit more specific when we do look at industrial REITs, pretty much below that nearly every single year, although we do note over the next 12 months, it is anticipated to increase to 84, just something to consider. We then look at the AFFO per share, very nice growth as we can see over the longer term, more than 3 times in fact, although we do anticipate a drop over the next 12 months. In terms of percentage format though, pretty strong across the board, some years a lot better than others, the more recent year negative 1%, and we can see over the next 12 months negative 8% anticipated. In terms of sales growth, nearly double digit every single year, the last 2 years looking very strong, 33% in 2023, and we can clearly see the top line has increased more than 4 times over the last 10 years, and we also see that share dilution year on year. In terms of the ROIC, nice to note, 4% in 2023, pretty much around the 3 to 4% level consistently. And when we do look at the margin, again, another sign of operational efficiency, 24% in 2014, 41 in 2023. We then get to the net debt to EBITDA, so below 5, we bring it down from 5.5 for the industrial aspect of REITs. And what we note, it has been straddling around that level, but it has been decreasing over the longer term. 4.88 looking very nice in 2024, which will help alleviate some of that compression on that dividend safety score. We then jump into the valuation model. Let's get to that intrinsic value today, and it is sitting there at $125. Now, margin of safety at 10%, a buy at 113. At 15%, it isn't quite there yet. We're talking around $2 shy, so you could argue it's pretty much around a 15% margin of safety based on the estimates and judgments. With Wall Street, well, they see 21% upside, $132 price target for the next 12 months, higher than our intrinsic value, so they definitely consider this a very strong buy. As always, let us know your thoughts. We then move on to ADC, the first one with a triple buy rating. One thing to know about this, they do pay those dividends on a monthly basis, and the yield is just under 5%. P to FFO 14.93. As we can see, it is getting lower as we move on. Over the last 12 months, down 7%. Over the last 10 years, up around 100%, and a lot of people do classify this as the baby Realty Income. Dividend safety score then 70, so it does look to be safe. Market cap just over 6 billion. It is a mid-cap company, and we do see here it was reaffirmed last month. Dividend safety score, meaning dividend cut unlikely. Last recession then, similar to Prologis, they did cut the dividend. They had average growth though, and they did trail the S&P, not as poorly as Prologis, with their negative 67% return. Very poor increase this month, well in fact this year, so just bear that in mind. Over the last 5 years though, they have increased it at 6%. One thing to bear in mind, on this channel we want to see 4% as a minimum just to keep up in line with inflation. Over the last 20 years, 2%, again, a little bit more on the disappointing side. They have, however, been increasing those dividends for the last 11 years consecutively. In terms of dividend yield theory then, what we can see, another double undervaluation signal, quite nice for a company that also pays on a monthly basis, and they're only marginally higher now than the real estate sector, 13.7 versus 14.7. In terms of AFFO, well, not only below 90%, but it has been decreasing, 74 in that more recent period. And when we get to the AFFO, as always, one thing I love is to see consistency, and arguably something that I would be willing to pay a bit more of a premium for companies that we do get to see that throughout their metric. In terms of sales growth, well, more than 5 to 10% year on year, so that is very strong. And when we look essentially at their AFFO growth, again in the mid digits year on year on average, 3% however on the more recent period. We then move on to total sales. Again, they pretty much increased their top line 10 times over the last 10 years. However, do bear in mind, one of those REITs that do dilute your position at an incredibly rapid rate. In terms of ROIC, between that 3 to 5% that we want to see, although moving in the wrong direction, so ideally let's get it back up to the 5%. Nice to note 4% on a trailing 12-month basis. And in terms of the margins, pretty high. Yes, it has been decreasing, so a sign of operational deficiency, but still nonetheless looking good at 48%. And when we do get to that net debt to EBITDA level, 5.55, so pretty much bang on that maximum we want to see. 4.88, so anticipated to lower by a decent amount into the next 12 months. As always, if you do enjoy the content values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, intrinsic value at 66.88 would indicate essentially a margin of safety bang on at the current price of 10%. So do bear that in mind whether or not that is something that is warranted if it is a monthly dividend payer and you are happy with the consistency of the metrics. For those that are looking at 15%, you would have to wait around 56.85. So with the 10% MOS level in terms of Wall Street and their predictions, one of the lower upside today's 9% with their price target $66, pretty much around that intrinsic value that we have also calculated. We then move on to EPRT, Essential Properties Realty Trust, a double strong buy rating, very rare to see on the channel, a buy from Seeking Alpha, trading towards the upper end of the 52-week range, a forward yield 4.3%, and a P to FFO again on the lower end of today, 14.3. Over the last 12 months, well, one of the few that is actually up. Over the last 5 years, up 32%. In terms of dividend safety, well, the first one that we see borderline safe at 60, market cap just under 5 billion, a mid-cap company, and we can see reaffirmed at 60. What this means then, a moderate risk of a dividend cut over a full economic cycle. In terms of dividend growth, well, they've kept it in line with inflation over the last full year. However, over the last 5, a nice rapid 21%, which is always disappointing to see when you get one that is fairly low in comparison. In terms of number of years, well, they've increased those dividends over the last 5 years. And on dividend yield theory, when we do take a look, you could argue reasonable valuation is pretty much around the levels of the 5-year average on both the yield and the forward P to FFO aspect. And it is again trading marginally higher than that sector PE. In terms of the AFFO payout, well, what we see below 90% over the longer term, 68 in the more recent year, so pretty low as things go for REITs. And then when we look at the AFFO, it has increased, pretty much doubled across the last 6 years and anticipated to increase again over the next 12 months. When we take a look at the percentages, very nice to note, although it has been coming down, still 8% in the more recent year, 6% over the next 12 months is nice to see. and they have been increasing their top line at a fairly rapid rate, much better than the minimums that we do want to see. And over the longer term, we can see again more than 10 times their top line. But as always, a little bit of a damper with REITs, but they do dilute your position over the longer term. ROIC, well, nice to note, 5% in the more recent year, which has also been increasing over the longer term. And when we do take a look at their margins, again, another operational efficiency up from 34 to 62% in 2023. And finally, when we do come to that net debt to EBITDA, not only below 5.5 in 2023, but we can see a decreasing trend from 2019, expected to go much lower over the next 12 months, 3.77, and if they do execute on that plan, then we should see that dividend safety move up from borderline safe to safe at a bare minimum. Now, in terms of the valuation, don't forget as well, a reminder, you can grab a copy of this model by clicking on the pinned comment below. The intrinsic value does get to $29.75. With the current price at just under $27, a 10% margin of safety would indicate a buy pretty much at that current trading price. And again, as we saw, a double strong buy, one of them essentially being Wall Street and another buy. So it does look like quite a popular one with the analysts. In terms of Wall Street and their forecast, well, over the next 12 months, they have a price target just under $30, pretty much in line with our intrinsic value at 10%. But the question is whether or not you believe that that is warranted for a high quality company. So in today's episode, we ran through 5 high quality REITs. We had REXR at the beginning, we had EQIX, we had Prologis, Agree Realty, and finally EPRT. Let us know your comments below whether you are adding to any of these, whether you like them, they're on your watch list, or maybe for whatever reason you're not interested in them at all. As always, if you enjoyed today's episode, value was provided, smash that like button, hit that subscribe and bell button, and as always, we'll see each and every one of you on the next one.